Hi, my name is George Dagnino. I'm the editor of the Peter Dac Portfolio since 1977. What I would like to talk to you about is a subject that everybody seems to believe in, but no one really looks into the details of it. In other words, is long-term investing a viable investment strategy for everybody? I think there is the general belief that the long-term investment strategy is a good idea. If you look at long-term charts, they show, from let's say early 1900 to current day, that the market is always going up. So, if you live long enough, you should make quite a bit of money, usually around 7–8% a year. So why give up this concept? A lot of gurus and portfolio managers and mutual fund managers suggest that that's the way to do it. But let me look into the details and let's see really if this is a good idea, for whom is a good idea. This is a chart of the S&P 500 from 1967 to 2012. Okay, what you see is that the market really has not done anything from 1968 to 1982. Then went strong up 20% a year as the baby boomers started buying and investing, and so the big boom of the 80s and early 90s. And then from 1999 to 2012, late in 2012, the market has not done anything. So really, the long-term investing is, yes, it's true that it's a good idea, but let's say you are 55 and you are at this point in time or at this point in time, and then for 12, 13, 14 years, you don't see any growth in your portfolio, and probably when you were scared, you sold here and you bought back here again. So really, your portfolio, your 401k, is not growing. So here, of course, yes, long term is fine, but how do you know that you are not in this period or in this period? Okay, now let's look in the details of the previous chart and see really what long-term is all about. From 1969 to 2012, they're roughly 43 years. The market was flat from 1969 to 1982, and then from 1988 to 2012. So the market really was flat for 27 years. The market was very strong, growing very rapidly from 1982 to 1998, which is 16 years. So really, from 1969 to 2012, there were considerably more years when the market was flat than the market was growing up at multi-year growth at 20%. So let's be careful of what we mean by long-term, because you have less than a 50-50 chance of being in a long-term profit-making rising stock market. Or let's put it in a different way. If you are now sitting that you have to invest, what would you believe? Would you believe that we are in a period like this or in a period like this? Well, if you are an odd maker and you don't know much about the economy and you're not as smart as everybody else is, like for instance, I'm not as smart as everybody else is, I would rather say, well, the odds are saying that really I don't know. So at this point, if I want to manage my portfolio and be careful, I have to say, well, the odds are I have to work in a period where the market goes up, the market goes down, but maybe it's not going to go up like from 1982 to 1998. This is why it's very important. What I strongly believe is that you have to know what you're doing. You have to be knowing how do you manage risk, how not to lose money. Really, the bottom line is that the long-term investing depends on your age. Of course, if you are 15 like my grandchildren, let's say, well, you give a few $1,000s, you know that they're going to live another 50, 60, 70 years, hopefully 80 years or whatever it is, and they are bound to make money. But really, it's like throwing a dart, on a board. How much money are they going to make? Well, they don't need much money to start with, first of all. So really, long-term investing depends on your age, but also depends on your money. When you are around 45, 50, that you're beginning to have a nest egg, and now you have to say, I'm going to invest for the long term, you don't have the luxury of making a big mistake. So I think from an investment strategy viewpoint, again, this is very important, what I strongly believe, from an investment strategy viewpoint, you cannot believe in long-term investing because you have to protect that nest egg. You have to make sure that it doesn't lose money. So you have to manage risk. You have to manage that you're going to have maybe not a great return, but minimize your losses. Okay, I know what you're thinking right now. Well, George, you're making things complicated. Life is complicated. Investing is complicated. Driving a car is complicated. Everything is complicated. But the only way you can invest at a mature age with a nice nest egg is that you have to have an investment process and never change it. Maybe improve it, but don't change and give it up and throw everything in the air. No. You have to have an investment process. You have to start from a certain point and go back and start step by step by step, which, by the way, is going to be the subject of a different video. The purpose, the objective of your investment process is that you have to deal with some very crucial portfolio management issues. That you like it or not, it's not that I want to make it complicated for you, but that's life. And there are three basic things that you have to face. You have to manage your losses. That's the most important thing, because if you start losing money, then you have to waste time to recover the money that you lose. So you have to manage your losses. You have to manage the volatility of your portfolio, because if your portfolio goes up and down, my grandchildren say, Grandpa, I made 20% yesterday, and then the next day say, hey, Grandpa, I lost 15% today. That's not portfolio management, that's gambling. So you want to manage the volatility of your portfolio. Why? Because you want to manage your returns. You know that you're going to make a certain amount of money, let's say 3, 4, 5, 6%, 10% a year, plus minus a small percentages. So you're trying to minimize really the risk. These are the main issues of portfolio management. Everybody has his own process. Everybody has his own approach. No one is right 100%. What do? I follow what I call the business cycle, because what the business cycle tells me that the asset classes or the type of investments that are when the economy is growing very fast is totally different from the type of assets or investments when the economy is growing very slowly. This is a subject that I will deal in another video. Well, I want to thank you very much for following this video. Hopefully I gave you some ideas that can be useful for your portfolio management and for your investment. Again, thank you very, very much, and I hope to see you soon. Take care.